Hello, hi, welcome to the session. Let's wait for about 3 or 4 minutes and then we proceed. Okay, let's wait for about 3 or 4 minutes. Let's wait for about 3 or 4 minutes and then we start off. All right, let's wait for about 2 or 3 minutes more. And then we proceed. All right, let everyone come in. Come on, everyone, settle down. Take 2 more minutes. Yeah, take about 2 more minutes. Let everyone come in. Hmm. Let's take another 2 more minutes. Let's wait for everyone to join. Okay, are we done? Okay, 30 seconds and then we start. In their pursuit and journey of preparation for the CA Foundation and Intermediate examinations by providing top educators, quality content, and overall a great learning experience. So come, let's crack CA exams with Unacademy, India's largest online learning platform. Welcome to the session once again. Before we proceed with the session, a little introduction about the Educator today. Hello, I'm Prathik Gupta. I'm a Bachelor of Commerce from Christ College, Bangalore University. I am an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of the Cost Accountants of India, and an associate member of the Institute of Company Secretaries of India, and also a law graduate from Karnataka State Law University. I am currently a practicing chartered accountant and also a visiting faculty for CA subjects and an educator for CA students, both offline and online. Prior to starting on my own, I worked with SR Bartley Boy and Associates. That's the Indian member firm of Ernst & Young Global in the Audit and Assurance Department, and Ernst & Young India, EY India, in the Mergers and Acquisitions Department. Post that, I worked with the Manipal Group in Bangalore as the corporate controller of their German subsidiary located in Frankfurt, Germany, and it was only after I got back from Frankfurt, Germany, that I decided to start something on my own, and that also gave me an opportunity to become an educator, which in turn has given me this opportunity today to take this session for you young, bright and enthusiastic CA aspirants. Thank you so much for giving me this opportunity, and anytime during the session, in case you have any questions, queries, observations or discussions, please do not hesitate to drop in a line and I will take up the matter for problem solving or for discussion as soon as I can. Once again, thank you for giving me this opportunity, and I hope you find the session useful. Let's proceed. Like I told you, Unacademy caters to you in your to help you in your preparation for CA Foundation and Intermediate examination through 3 platforms. That is YouTube, special classes, and the Plus platform of Unacademy, which is the premium platform of Unacademy and also a payment-based subscription model. More about which I will tell you as we go on. YouTube and special classes are absolutely free, but they provide to you immense resources and value to help you in your preparation for the CA Foundation and Intermediate examinations. What you're attending right now is the YouTube session, and also you can go on to YouTube and type my name, which is Prathik Gupta, Prathik, and you will see all my other sessions on YouTube which are also present, which will help you in your preparation for the CA Foundation and Intermediate examination. The same name, Prathik Gupta, Prathik, you can also look it up on the Unacademy Learning app. And you will find all the hundreds of hours of special classes that I have conducted there, which will be of use to you in your preparation for the CA Foundation and Intermediate examinations. Now, special classes are available on the Unacademy Learning app, which I will tell you about in the further slides. So let's talk about the premium platform of Unacademy, which is the Plus platform. Now, I personally recommend you and encourage you to get on to the Plus platform of Unacademy as soon as possible for the following reasons. Firstly, you get it provides daily live classes where you get to chat with your educators, engage in discussions, ask your doubts, and answer polls. All this while the class is going on. Yes, you heard it right. All this while the class is going on. You do not need to wait for the end of the class. You do not need to wait for a couple of days after the class. You do not need to wait for the weekend after the class, and neither do you need to wait to fix up an appointment with the educator. You can clear your doubts and have discussions with your educator on a real-time basis while the class is going on. It's as simple as you lifting your hand up in a live classroom, and your educator will be happy to answer your query and questions. The second reason why I recommend and encourage you to get onto the Plus platform of Unacademy as soon as possible is because it conducts various live tests and quizzes at regular intervals to help evaluate your preparation and also analyze your performance. Now, you might wonder why this evaluation and analysis of performance and preparation is necessary. Please remember, whenever you're preparing for a professional examination, it is of paramount importance that you check your level of preparation or stage of preparation from time to time to know which areas you are prepared, which areas you require more preparation, and which areas you require external help. So basically, the Plus platform of Unacademy helps to break your preparation into 3 areas: your weak areas, your not so strong areas, and your strong areas. and whatever limited preparation time you have for the examination, it helps you utilize that time wisely towards those three areas, in the sense more time for your weak areas, little lesser time for your not so strong areas, and less time for your strong areas, until a time when your weak areas and your not so strong areas eventually become your strong areas. Okay, so basically the Plus platform of Unacademy ensures minimum wastage of time and maximum utilization of time in your preparation for the CA Foundation and Intermediate examinations. The third reason why I recommend and encourage you to become a part of the Plus platform of Unacademy is because of the structured courses it provides. All the courses on the Plus platform are structured in line with your exam syllabus to help you best prepare for it, which simply means all the Plus courses conducted on the Plus platform of Unacademy are prepared keeping in mind your exam syllabus. And once you complete a Plus course on the Plus platform, you can rest assured that you have completed your syllabus without missing out on any important or major points. And lastly and most importantly, the one subscription to the Plus platform gives you access to all the live and recorded courses to watch from the comfort of any of your devices, which simply means the one subscription to the Plus platform of Unacademy will give you access to all the live and recorded Plus courses and all the live and recorded special classes that Unacademy has to offer you to help you in your preparation. And you can view all these sessions from the comfort of any of your devices, which means you can watch it from your mobile phone, laptop, tablet, or desktop, as the case may be. And not only this, all these sessions are available 24/7 without any timing restrictions like 10 to 4, 10 to 5, or 10 to 6. You can view them whenever you want, and whenever you find time to prepare for your examinations, you can just pull out your mobile phone, log into the Unacademy Learning app, and make use of all the resources and courses that it has to offer to you. All right, and lastly, all these information is accessible from any location that you want, whether you're at home, whether you're coming back home from work, whether you're going to work, or you're waiting for someone for a meeting, or you're on a vacation, or you're in your native place and you have some time to spare. You can just pull out your mobile phone, log into the Unacademy Learning app, and start preparing for your examinations. All you require is a good internet connection or data plan, which all of us are blessed with today. So keeping these points in mind, among the many others, I strongly recommend and encourage you to get onto the Plus platform of Unacademy in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. All right, please take about 30 seconds, go through this slide, and then we proceed. Any questions, please ask. Any questions, please ask. Okay, then like I told you about the special classes, those are there on the Unacademy Learning app. For those of you who have downloaded the Unacademy Learning app and are using it, I thank you very much, and I request your support in the future as well. For those of you who have not yet downloaded the Unacademy Learning app, I request you to go to the Play Store on your mobile phone, download the Unacademy Learning app, put in your mobile number where you get an OTP, and using that you can register on the Unacademy Learning app. It's as simple as that, with no lengthy procedures or complicated procedures. Now you might ask me, okay, you've downloaded and installed the Unacademy Learning app, you've also registered on it using your mobile number and OTP, so what next? Please remember, the Unacademy Learning app gives you access to all the live and recorded special classes that Unacademy has to provide to you free of cost to help you in your preparation for the CA Foundation and Intermediate examination, and also gives you access to all the live and recorded Plus courses that Unacademy offers to you in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. The Plus platform is a premium platform of Unacademy, which is a payment-based subscription model. So keeping these points in mind, I request you to download the Unacademy Learning app, make use of it, register on it using your mobile number and OTP, and use the resources that are there to help you in your preparation, and also spread the word around and help the people around you get onto the Unacademy Learning app, and also help them register on it using their mobile number and OTP, and make use of the innumerable resources that Unacademy Learning app provides to you to help you in your journey of preparation for the CA Foundation and Intermediate examinations. Please take 30 seconds, go through this. Any questions, please ask me. Any questions, please ask. All right. Okay. Then, like I told you, the Plus platform of Unacademy is the premium platform of Unacademy, which is a payment-based subscription model and which has various subscription packages for the various examinations. The CA Foundation and Intermediate subscription packages provided by the Plus platform of Unacademy are as follows. The packages provided by the Plus platform of Unacademy are for 1 month, 3 months, 6 months, 12 months, and 24 months. The 1 month package normally costs you about 3,500. The 3 month package costs you about 8,750. The 6 month package costs you about 14,000 rupees. The 12 months package costs you about 17,500, and the 24 months package costs you about 21,000 rupees. Please remember, all these are the list prices. So before you make the payment for the package of your choice, please do not forget to use the code Prathik to get an instant discount of 10% on the above listed price. I repeat, please do not forget to use the code Prathik. Prathik, that's me, Prathik, to get an instant discount of 10% on the above listed price. So the after discount price of the various packages are: the 1 month package will cost you rupees 3150, the 3 month package will cost you rupees 7875, the 6 month package will cost you rupees 12,600, the 12 month package will cost you rupees 15,750, and the 24 months package will cost you rupees 18,900. So you see, immediately you get a savings of 10% when you use my code Pratik. Now, I recommend you to start off with the 12 months package at least, because of the following two reasons. Because it is cost effective. If you compare the per month cost of the 1 month package and compare it with the per month cost of the 12 months package, you will see you get great savings immediately. And most importantly, as the CA Foundation and Intermediate course is provided to you in one package, a 12-month package will be very beneficial for you because it covers the entire duration of both the courses, as it normally takes about a year's time for you to prepare and clear the CA Foundation and Intermediate examination. So if you're getting the duration of both the courses, that is CA Foundation and Intermediate examination, in one package at a very cost-effective price, I think that's a very good deal, and it will result in great cost savings. Now, but having said this, you're free to choose the package of your choice. But before you make the payment, please do not forget to use the code Prathik, Prathik, to get an instant discount of 10% on the above listed price. You can also avail the no-cost EMI option available for the 6 months, 12 months, and 24 months packages, just in case you do not wish to make the entire payment at one shot. The payment options available to you are internet banking, debit card, credit card, and also all the coins that you've accumulated while watching the special classes can be redeemed when you make the payment for the Plus subscription. So keeping these packages, attractive packages in mind, and the benefits of the Plus platform, I suggest you get onto the Plus platform as soon as possible in order to enhance and accelerate your preparation for the CA Foundation and Intermediate examinations. Please take about a minute, go through this slide, and then we proceed. Any questions, please ask me. Any questions, please ask. Take about a minute. Any questions, please ask me. Any questions? Okay, so let's start off with theory of demand and supply part 2, because part 1 was started yesterday, and today we are going to continue with part 2. So where we are going to discuss the important concepts on demand and supply. And please remember, we are taking this course on business economics for CA Foundation. So in case you have any questions, queries about this topic, you can always get back to me and I will be happy to address your concerns. And we finished 2 topics, that is introduction, and we finished the basic problems of economics, and now we are doing the theory of demand and supply, which was started yesterday, and we will continue today. So we will start off from where we stopped yesterday. Okay, and any questions, you can always ask me. I'll quickly run through what we did yesterday. We quickly did the meaning of demand. Okay, what does demand mean? Then what determines the demand? The price of the commodities, price of related commodities, income of consumers, tastes and preferences of consumers, other factors, consumer expectations. All right, all this was discussed yesterday in the session in detail, so I request all of you to go through that. Then each of these points, that is price of commodity, price of related goods, income of consumer, tastes and preferences of consumers, consumer expectations, other factors such as size of population, composition of population, the level of national income and distribution, consumer credit facility and interest rates. All these points were discussed in detail yesterday in part 1. So we will not be touching upon it now. You can go through part 1. Then we saw the demand function, where demand dx is demand for a particular product x is equal to the function of price of the commodity, m is the price of money income of the consumer, py is the price of its substitutes, pc is the price of complementary goods, T is the taste, consumer tastes and preferences, and A is advertisement. So demand is the function of all these. We quickly saw this. Okay, then we saw the law of demand, and we saw what Professor Alfred Marshall defines the law as: the greater the amount to be sold, the seller must be at a price at which it is offered, the smaller price. So basically the law of demand means lesser the price, more demand; higher the price, lesser the demand. Okay, so demand schedule, we discussed this topic as well yesterday, where we saw the demand schedule in the various circumstances, how when the price is changed, how the demand for a particular product changes. We saw the demand curve, market demand schedule, we discussed this as well. Then we saw the market demand schedule for 3 customers, okay, and how they behave. We even saw this demand curve. We saw the demand curve coming downwards, which simply means as the price is reduced, the quantity demanded increases, and as the price is increased, the quantity demanded reduces. Okay, then we saw the market demand curve, the rationale of law of demand. We saw the law of diminishing marginal utility. Now, why I'm rushing through this is because all this was done yesterday. I'm just trying to recollect what we did yesterday, and we will start off from where we stopped yesterday. Okay, we saw law of diminishing marginal utility, price effect, which constitutes substitution effect and income effect, arrival of new customers, different uses, and then the exceptions to the law of demand. This is where we stopped yesterday. Okay, so we stopped at arrival of new customers and different uses, which simply meant that as the price is reduced for a particular product, the new customers who earlier were scared or they found it expensive to buy the product at that price will now suddenly jump into the market and will buy the product. So that's why the demand will go up as the price comes down. And different uses is the more uses, alternate uses a product has, the more demand it will have. Because if you're paying a high price for a product and its demand and its utility is just one, that means it can be used for one major reason, then it's likely that the demand will not be much. But if the prices are coming down and the utility of the goods, it can be used for many other purposes, then the demand will go up. Okay, so we stopped here, so we will continue with this. Exceptions to the law of demand. Now, the law of demand simply says if the price goes down, the demand goes up, right? So if the price comes down, the demand goes up. This is the normal law of demand. So now we are going to discuss the exceptions to this law. According to the law of demand, other things being equal, more of a commodity will be demanded at lower prices than at higher prices, right? That's what we saw in this box. The law of demand is valid in most cases. However, there are certain cases where this law does not hold good. Okay, so we are now going to discuss the exceptions. The following are the important exceptions to the law of demand. Okay, so we are going to now quickly go on to the exceptions to the law of demand. Now, what are the exceptions? First one, conspicuous goods. Okay, now please listen carefully. It's an interesting concept. Articles of prestige value or snob appeal or articles of conspicuous consumption are demanded only by rich people, and these articles become more attractive if their price go up. Such articles will not conform to the usual law of demand. This was found out by Weblin in his doctrine of conspicuous consumption. And hence this effect is called Weblin Effect or Prestige Goods Effect. Weblin effect takes place as some consumers measure the utility of the commodity by its price. If the commodity is expensive, they think that it has got more utility. As such, they buy less of this commodity at lower price and more of it at a higher price. Diamonds are often given as an example in this case. Higher the price of diamonds, higher is the prestige value attached to them, and hence higher is the demand for them. Okay, so the first exception to the law of demand, that as the price goes down, the demand goes up, and as the price goes up, the demand goes down, is conspicuous goods. Conspicuous goods are also known as prestige goods or snob goods, articles of conspicuous consumption, which simply means that these goods have a inherent value attached to them with the price. and they are normally bought by the rich people. So they think that as the price is higher, the goods will also be of more value and utility. So as the price of these goods increases, the demand also for them increases by the rich people who would like to show that yes, okay, we bought an expensive article, and because it is so expensive, it has more utility. The example is diamonds. As diamond gets, some rich people who like to flaunt, so they want to buy the most expensive diamond around, right? So they do not, if the price of the diamond comes down, they're like, nah, that diamond is no use, the price is coming down. But if the same diamond is sold at double the price, in their mind, that double the price gives them more utility. Okay, so that's the reason why these are known as conspicuous goods, and they are an exception to the law of demand. That lower the price, higher demand, higher the price, lower the demand, because these goods, as the price goes up, the demand also goes up. Now, like we saw diamonds in one case. Can you give me another example? Cars. Okay, people who are rich and very very wealthy, they like to show off in cars. So if a car is not expensive, it has no utility. The more expensive a car is, the more utility it has. So as the price of that car goes up, their demand for it also goes up. Okay, so that's what you mean by conspicuous goods. Then Giffen Goods. Now, what is Giffen Goods? Sir Robert Giffen, a Scottish economist and statistician, was surprised to find out that as the price of bread increased, the British workers purchased more and not less of it. This was something against the law of demand. Why did this happen? The reason given for this is that when the price of bread went up, it caused such a large decline in the purchasing power of poor people that they were forced to cut down the consumption of meat and other expensive foods. Since bread, even when its price was higher than before, was still the cheapest food article, people consumed more of it and not less of it when the price went up. Okay, so now let's talk about Giffen Goods. Now, Giffen Goods was what happened. The Scottish economist observed that when the price of bread went up in Britain, more and more people started buying it instead of less people. So it was an opposite to the law of demand. So he wondered why this happened. So on closer observation, he saw that because the price of bread had gone up, it caused such a large decline in the purchasing power of poor people that whatever money they had, it went into the purchase of bread, that they did not have money to buy meat and other things to eat. So the consumption of meat and other consumables went down, and all their money went into bread. So they started buying more and more bread to satisfy their hunger needs and things like that. So because the rising price reduced the purchasing power of the poor people, more and more bread was bought at more and more price, but giving sacrifice of the other meat and other consumables that were there. So in this slide, we spoke about conspicuous goods and we spoke about Giffen Goods as exceptions to the law of demand, that when price goes down, the demand goes up, and when the price goes up, the demand goes down. All right, please take about 3 or 4 minutes, go through this slide. Any questions, please ask me. This is an important question from the exam point of view as well. Any questions, please ask. Take about 3 or 4 minutes. Any questions, please ask. Please take about 2 or 3 minutes more. Any questions, please ask. This is an important concept. Try and understand the concept. Any questions, please ask me. Hi Debashish, how are you? All well? Okay, take about a couple of minutes more. Yes, Debashish, what's your comment? Yes, Debashish, I'm sorry I didn't understand your comment. Is there some concern you're facing, Devashish? All right. Sure, Devashish. Thanks for the advice. We'll keep it in mind. Thank you. Thank you so much. I wish you all the best for your examinations. All right. Oh, good for you, Devashish. Very nice. I'm happy to hear that. I am a CA as well. Right? Thank you so much. Okay. Please take about a minute more and then we proceed. Any questions? Please ask me. Okay, now we look at the third exception to the rule of law of demand is conspicuous necessities. The demand for a certain goods is affected by the demonstration effect of the consumption pattern of a social group to which an individual belongs. These goods, due to their constant usage, become necessities of life. For example, in spite of the fact that the prices of television sets, refrigerators, coolers, cooking gas, etc., have been continuously rising, their demand does not show any tendency to fall. Okay, so to the the next exception to the law of demand are conspicuous necessities. The demand for certain goods is affected by the demonstration effect of the consumption pattern. All right, so basically, certain goods are consumed in our day-to-day life, which we really don't care if the prices go down or prices go up too much, but these are really required. They are necessities. Now, what are they? They slowly become necessary. Luxuries become necessities. Like, for example, television sets, refrigerators, coolers, cooking gas. Even though there might be a increase in their price, but their demand does not tend to fall too much because they are conspicuous necessities. The important word here is necessities. Okay. Then, fourth one, future expectations about prices. It has been observed that when the prices are rising, households expecting that the prices in the future will be still higher tend to buy larger quantities of such commodities. For example, when there is a widespread drought, people expect the price of food grains would rise in future. They demand greater quantities of food grains as their price rise. However, it is to be noted that it is not the law of demand which is invalidated, but there is a change in one's factors which was held constant while delivering the law of demand, namely change in the price expectations of the people. So here what we see, future expectation of a price. If we know that a particular goods is going to be more expensive as we go on, then the price of it will, even though the price of it goes up, but the demand for it also goes up. Another prime example is where this year when we had the lockdown due to COVID, now the food, vegetables, milk and other consumables, now the vegetable prices and everything went up because of scarcity of demand or because of too much of demand and supply being poor. But then we always thought that future, whether the prices of them will rise, or will we get those products in the future or not. So even though the price went up, we kept purchasing more, right? So this is the future expectations about prices. So when there is a expectation in future that the prices of a particular commodity will rise, then as the price rises, the demand for a particular product also rises. Okay, so this is the fourth exception to the rule of law of demand. Okay, then we have the fifth one. The law has been derived assuming consumers to be rational and knowledgeable about market conditions. However, at times consumers tend to be irrational and make impulsive purchases without any calculations about the price and usefulness of the product, and in such context the law of demand fails. Okay, so sometimes there is an irrational behavior of consumers when they purchase something. They do not try to take the price or the supply or demand of the product in mind, and they just go on purchasing a particular product. That brings a fall in the law of demand. Okay, so the law has been derived assuming consumers to be rational and knowledgeable about market conditions. However, at times the consumer tends to be irrational and make impulsive purchases without any rational calculations about the price and usefulness of the product, and in such context the law of demand fails. Okay, so here we saw point number 3, 4 and 5, that is about conspicuous necessities, that when a particular item is a necessity, it doesn't matter whether the price is going up, but the demand for it also goes up, or it does not fall. And then future expectations about prices, when the future expectation of a particular price is high, then you tend to buy more of that product even though the price is going up. All right. Yes, and then we have irrational behavior of the consumer. So many times the consumer, without thinking about the price and quantity, just goes on purchasing it, which again fails the law of demand. Please take about 3 or 4 minutes, go through this, and then we proceed. Any questions, please ask me. Please take 3 4 minutes. Any questions, please ask me. Any questions, please ask. Any questions, anyone? Please ask me. Let me know once you're done. Take about 2 more minutes. Anyone has any questions, please ask me. Let me know once you're done. Okay, do we have any questions? Anyone? All right, just about 10 more seconds and then we proceed. Okay, then the point number 6, the sixth exception is demand for necessaries. The law of demand does not apply in case of necessaries for life. Irrespective of the price changes, people have to consume the minimum quantities of necessary commodities. Similarly, in practice, a household may demand larger quantity of a commodity even at a higher price because it may be ignorant of the ruling price of the commodity. Under which circumstances the law will not remain valid. For example, food, power, water, gas. So again, it comes down to if there are necessities which we need it for our day-to-day survival, then even though the price may go up, the demand for it may not substantially fall. In fact, the demand will go up for it because once we have certain necessities, we cannot let go of them and we need to consume them, right? So necessities like food, power, water, gas. What are the other necessities that you could think of? Today, I mean, on the lighter side, today, internet connection, data plans, mobile phones, can we live without it? No. So even a luxury has become a necessity. So even if the prices go up for that particular commodity, do we let go of those things? No, we can't, and we don't let go of those things. Okay, so necessities do not apply to the rule of demand, law of demand. Speculative goods. In a speculative market, particularly in the market of stocks and shares, more will be demanded when the price are rising and less will be demanded when the price decline. Okay, so now we are talking about speculative transactions and share market, shares and stocks. So please remember, when the prices of stocks are rising, as it is rising, the people will start buying more because the prices are rising, right? So they will buy at a lower price and sell at a higher price. And similarly, when the prices are coming down, oh sorry, not like this, when the prices are coming down, that time they will tend to sell because they'll be able to sell it at a higher price and buy it at a lower price. So speculative transactions again are an exception to the law of demand. The law of demand will also fail if there is any significant change in other factors on which demand of a commodity depends. If there is a change in the income of a household or prices of the related commodities or tastes and fashion, etc., the inverse demand and price relation may not hold good. Okay, so the law of demand will also fail if there is any significant change in other factors, such as change in the income of the household. If the income of the household comes down, the demand will come down, or in the prices of related commodities, or in the tastes and fashions. So the inverse demand and price relationship may also not hold good here, because if the income of a household comes down, then even if the price comes down, the demand may not go up proportionately. Okay, or similarly, if the prices of related goods go up or go down, and if the income of the house is lower, then that might not reflect properly in the law of demand. Okay, so these are two more cases of the law of demand. Please take about 2 minutes, go through this. Any questions, please ask me. Any questions, please ask. Take 2 minutes. Any questions? Take about 2 or 3 minutes. Any questions, please ask. Take 2 more minutes. Take another minute or so. Any questions, please ask. Take another 2 minutes. Just a second. Take another minute. Just give me a second. Okay. Then let's look at expansion and contraction of demand. The demand schedule, demand curve, and the law of demand all show that when the price of a commodity falls, its quantity demanded increases. Other things being equal, when, as a result of decrease in price, the quantity demanded increases, in economics we say that there is an expansion of demand, and when, as a result of increase in price, the quantity demanded decreases, we say there is a contraction of demand. Okay, so whenever in economics, whenever we see that due to the price decrease, if there is an increase in the demand of a particular product, it is known as expansion of demand. And if whenever the price goes up and there is a decrease or fall in the demand of a particular product, we say there is a contraction of demand. Okay. For example, suppose the price of apples at any time is rupees 100 per kilogram and a consumer buys 1 kilogram at that price. Now, if other things such as income, prices of other goods and tastes of the consumers remain the same, but the price of apple falls to 80 per kilogram and the consumer now buys 2 kilograms of apples, we say there is a change in quantity demanded or there is an expansion of demand. On the contrary, if the price of apple rises to 150 per kilogram and the consumer buys only half a kilogram, we say there is a contraction of demand. So whenever a demand goes up, we say there is expansion of demand, and whenever the demand comes down, we say there is a whenever the demand goes up, we say there is expansion of demand, and whenever the demand comes down, there is a contraction of demand. Please take 2 minutes and let me know. Take 2 minutes. Any questions, please ask. Any questions, please ask. Take 2 more minutes. Any questions, please ask. Okay, so the phenomena of expansion and contraction of demand are shown in figure 3, which is down. The figure shows that when the price is OP, which is this, and the quantity demanded falls to OL, we say there is a fall in quantity demanded or contraction of demand, or an upward movement along the same curve. Similarly, as a result of fall in the price of OP, the quantity demanded rises to ON. ON is this. We say there is a rise in quantity demanded or a downward movement on the same curve. So there is an expansion of demand and a contraction of demand. All right, please go through this diagram, take a minute or so, and then we proceed. Any questions? Okay, now let's look at increase and decrease in demand. Till now, we have assumed that other determinants of demand remain constant when we are analyzing demand for a commodity. It should be noted that expansion and contraction of demand takes place as a result of changes in the price, while all other determinants of price, that is income, taste, propensity to consume, and price of related goods, remain constant. The other factors remaining constant means that the position of the demand curve remains the same and the consumer moves downwards or upwards on it. What happens if there is a change in consumer tastes and preferences, income and price of related goods, or other factors on which the demand depends? Okay, so far, whatever we discussed, we always discussed keeping in mind that the other factors on which demand is based, like consumer preferences, income, changes in related prices and everything remains constant, and only because of the price, the demand for a particular item goes up and down. Now we are going to discuss that what happens if the other determinants of demand also go up and down. Okay, so in that case, let's have a look. Now, first case, a rightward shift in the demand curve. When more and more is demanded, when more is demanded at each price, can be caused by a rise in income, a rise in the price of a substitute, a fall in the price of a complement, a change in tastes in favor of this commodity, an increase in population, and a redistribution of income to groups who favor the commodity. So if all these other factors also changes, then there will be a rightward shift in the demand curve, which simply means the demand will go up. Okay, so we'll read it again. A rightward shift in the demand curve, when more is demanded at each price, can be caused by a rise in income, a rise in the price of a substitute, a fall in the price of a complement, a change in tastes in favor of this commodity, an increase in population, and a redistribution of income to groups who favor this commodity. So if these are the other factors on which the demand of a particular commodity is determined, and if these factors change in favor of the demand, then the demand curve will go more towards rightwards. That means the demand will go up. Now, in the following cases, there will be a leftward shift in the demand curve. When less is demanded at each price, can be caused by a fall in income, a fall in the price of a substitute, a rise in the price of a complement, a change in taste against this commodity, decrease in population, and redistribution of income away from groups. So let's take the opposite of what we read on top. Now, if there is a fall in income, obviously the demand will come down. If there is a fall in the price of a substitute, the demand for our particular product will come down. If there is a rise in the price of a complement, then the demand for this will come down. And if there is a change in tastes against this commodity of the consumers, that the consumers no longer want this commodity, then again the demand will come down. If there is a decrease in population and a redistribution of income away from groups who favor this commodity, there will be a fall in demand and the leftward shift in the demand curve. All right, please take about 2 or 3 minutes, go through this, and then we proceed. Any questions, please ask. Okay, any questions, please ask. Please take 2 more minutes. Any questions, please ask. Take about 2 more minutes. Any questions, please ask. Any questions, please ask. Take about a minute more. Okay, let's go on to the next one. Now, movements along the demand curve versus shift of the demand curve. It is important for business decision makers to understand the distinction between a movement along the demand curve and a shift of the whole demand curve. A movement along the demand curve indicates change in the quantity demanded because of price changes, other factors remaining constant. A shift in the demand curve indicates that there is a change in the demand at each possible price because one or more other factors such as incomes, tastes, or the other price of other goods have changed. Okay, so now there are two concepts here. One is a movement of the demand curve, that is goes from top to bottom, or there's a shift if it goes from right. Okay, at different prices it changes. Now whenever there is a movement of the demand curve from top to down, that simply means the change in the demand due to the price of the goods. But whereas there is other factors remaining constant, but wherever there is a shift in the demand curve, it simply means that the other factors such as incomes, tastes, or price of other goods have also changed. Thus, when an economist speaks of increase or decrease in demand, he refers to a shift of the whole curve because one or more of the factors which were assumed to remain constant earlier have changed. When the economist speaks of change in the quantity demanded, he means movement along the same curve. Okay, expansion or contraction of demand which has happened due to fall or rise in price. So please remember, whenever there is a change in quantity demanded, it means up or down change in quantity demanded due to the price. But whenever an economist speaks about increase or decrease in demand, he refers to the shift of the whole curve because one or more factors which were assumed to remain constant have not remained constant anymore. Okay, so there are two concepts here. One is change in demand, and increase or decrease in demand. All right, please take 2 minutes, go through this. Any questions, please ask. Take 2 minutes. Any questions, please ask. Any questions, please ask. Now we speak about elasticity of demand. Um, Okay, till now we were concerned with the direction of the changes in prices and quantities demanded. From the point of view of a business firm, it is more important to know the extent of relationship or the degree of responsiveness of the demand to changes in determinants. Okay, so far we spoke about what happens when the determinants of the demand are changed. Right now we will speak about the responsiveness or the degree of responsiveness of demand to changes in the determinants, which means if there is 1% change in the determinants, what percent change in the demand, whether positive or negative. If there is 10% change in the determinants, what percentage change in the demand. Okay, so now we will try to measure these changes, or to say we will try to answer the question by how much does the demand change due to change in price. Okay, so now we will talk in terms of percentages. So let's take the first consideration. Consider the following situations. As a result of fall in the price of a radio from 500 to 400, the quantity demanded decreases from 100 to increases from 100 to 150 radios. Okay, so what does this mean? Let's try to infer what does this mean. This simply means as the price drops by 20%, the quantity demanded goes up by 50%. Now, how did we get this? Price 500 to 400. 100 rupees has gone down. So 100 rupees divided by 500 into 100 is 20%. So when the price drops by 20%, the quantity demanded increases from 100 to 150. So how much has it gone up by? 50. So 100 plus 50 is 150. So when the price drops by 20%, the quantity demanded goes up by 50%. So here we are seeing the responsiveness of demand with the change in price. Are you clear? Okay, next. As a result of fall in price of wheat from rupees 20 per kilogram to 18 per kilogram, that means 10%. When the price goes down 10%, the quantity demanded increased from 500 kilograms to 520 kilograms. So how much is 20 of 500? It is 4%. Yes, 4%. So the demand goes up by 4%. So here, can we see a relationship emerging between the two? That is a percentage. We are finding out the responsiveness of increase or decrease in demand when there is a change in price. And in the third case, as a result of the fall in price of salt from 9 per kilogram to 750 per kilogram, the quantity demanded increases from 100 to from 1000 kilograms to 1005 kilograms. Here again, we need to find out the percentage of the responsiveness of change in quantity ordered, quantity demanded with change in price. Please take 2 minutes, go through this. Any questions, please ask me. Take about 2 or 3 minutes. Any questions, please ask. Take 2 minutes. Any questions, please ask. Take about a minute more. Any questions, please ask me. Any questions, please ask. Any questions? Okay. Now, what do you notice? You notice that as a result of all the fall in prices of radios, the quantity demanded of radios increases. Same is the case with wheat and salt. Thus, we can say that demand for radios, wheat, and salt all respond to price changes. Then, what is the difference? The difference lies in the degree of response of demand, which can be found out by comparing the percentage changes in the prices and quantities demanded. Here lies the concept of elasticity. So what I've done here is found out the percentage of changes. We all know that normally, according to the law of demand, when the price goes down, the demand increases. When the price goes up, the demand decreases. But the elasticity of demand tries to measure what is the level of change. Okay. All right. So, definition: elasticity of demand is defined as the responsiveness of the quantity demanded of a good to change in one of the variables on which the good depends. More precisely, elasticity of demand is the percentage of change in quantity demanded divided by the percentage change in one of the variables in which the demand depends. Okay. So, in this case, what we saw was the price. All right. Now, these variables are prices of the commodity, price of the related commodities, income of consumers, and other factors on which the demand depends. Thus, we have price elasticity, cross elasticity, income elasticity, advertisement elasticity, and elasticity of substitution. It is to be noted that when we talk of elasticity of demand, unless and until otherwise mentioned, we talk of price elasticity only. In other words, if it is the price elasticity of demand, which is usually referred to as elasticity of demand. Okay. Now, elasticity of demand simply means the change in the demand due to change in price, and we calculate it as a percentage. Now, not only price, we can also measure it as a function of the other determinants of demand as well, that is income of consumers, factors, demand depends, and all that. But if until anything is mentioned, then we need to assume it is price elasticity. Hi Isha, how are you? Thank you so much. Where are you from, Isha? When is your attempt? Okay, basically, Isha, you just need to remember the determinants of demand. What does your demand depend on? And then you will get to know, okay, how to remember these different elasticity. All right, nice, Isha. How is your preparation coming along? I'm good. Thank you so much for asking. December 2020 is okay. So your preparation is all well, all under control. All right, Isha. Chalo, very nice. Okay, so I'm glad you like my session and the way I teach. Thank you so much for the compliment, and I hope you're finding the session useful as well, Isha. Well, what is the confusion in elasticity, Isha? What is the confusing point? Is anything on this confusing for you? Let me know. Okay. Okay, now price elasticity. Now, price elasticity of demand expresses the response of quantity demanded of a good to change in its price, given the consumer's income, his taste and preference, and all other goods. In other words, it is measured as the percentage change in quantity demanded by the percentage change in price. Other things remaining equal. So, price elasticity is equal to percentage change in quantity demanded divided by percentage change in price. It's quite simple so far. All right. Take a minute, go through this, and then we go on to the next one. Any questions, please ask. Any questions, please ask. Any questions? Okay, now in symbolic terms, elasticity of price. So price elasticity is equal to delta Q divided by Q into P divided by delta Q. Delta P is equal to delta Q by delta P into QP by Q, where EP stands for price elasticity, Q stands for quantity, P stands for price, delta stands for very small change. All right, so okay, Isha, I'm glad you're doing that. Thank you so much. All right. Strictly speaking, the value of price elasticity varies from minus infinity to approach zero from the negative. Okay, sign because delta Q by delta P has a negative sign. In other words, since price and quantity are inversely related with few exceptions, price elasticity is always negative. But for the sake of convenience, we ignore the negative sign and consider only the numerical value of the elasticity. Thus, if a 1% change in price leads to a 2% change in quantity demanded of good A and 4% change in quantity demanded of good B, then we get elasticity of A and B as 2 and 4 respectively. How do we get 2 and 4 respectively? percentage change in quantity demanded divided by percentage change in price. So for quantity A, it is 2% divided by 1%, and quantity B is 4% divided by 1%, respectively, showing that the demand for B is more elastic or more responsive to price changes than that of A. Had we considered the minus signs, we would have concluded that the demand for A is more elastic than that for B, which is not correct. Hence, by convention, we take the absolute value of price elasticity and draw conclusions. So what we need to understand here is the price elasticity is always a positive number, and we need to ignore the negative number. So the formula here is percentage change in quantity demanded divided by percentage change in price, and that shows us that which product is more elastic or more responsive to change in price. All right, please take about 2 or 3 minutes, go through this. Any questions, please ask me. Any questions, please ask. All right, any questions, please ask me. Take 2 minutes. Let me know once you're done. Take about a minute more. Any questions, please ask me. Hello Ritika, how are you? Welcome to the session. I'm good, Ritika. How are you doing? Nice. How's your cough? Better? Okay. Chaliye, nice. All right. Any questions? Anyone? Let me know once you're done, and we'll continue. Any questions? Take another minute. Thank you, Ritika. I'm glad. Thank you so much. Okay, take about a minute more. Any questions, please ask me, and then we proceed. Thank you so much, Ritika. Thank you so much. Okay, shall we proceed? All right. Now, a few examples for price elasticity of demand case as follows. Illustration 1. The price of a commodity decreases from 6 to 4, and the quantity demanded of the good increases from 10 units to 15 units. Find the coefficient of price elasticity. So what is the formula for price elasticity? Percentage change in demand divided by percentage change in price. So what is the percentage change in demand? 50%? Yes? How do we get 50%? Percentage change in demand is equal to 5 divided by 10 into 100, which is equal to 50. Okay, and what is the percentage change in price? 2 divided by 6 into 100, which is equal to 33.33, right? So so the formula for price elasticity will be 50 divided by 33.33, which is equal to 1.5. So this is the answer what we get. So in this problem, what they've done, they've taken the absolute numbers. There is a 5 units change in demand, and there is a 2 rupees change in price. So 5 divided by 2 into 6 by 10 is equal to 1 by 5. Okay, so is it a plus or minus? It is a negative elasticity. So we get an answer of minus 1.5. Are we clear? Any questions here? Anyone? Okay, illustration 2. A 5% fall in the price of a goods leads to 15% increase in demand. Determine the elasticity and comment on the same. Again, percentage change in demand divided by percentage change in price, which is 15 by 5, which is equal to 3. The goods in question has elastic demand. These are your two illustrations. Please take 2 minutes. Go through this. Any questions? Please ask. Any questions? Please ask. Let me know once you're done. Any questions? Kritika, no questions. What about the others? Any questions? Okay, now we look at point elasticity. So far we looked at price elasticity. Now let's look at point elasticity. In point elasticity, we measure elasticity at a given point on a demand curve. The concept of point elasticity is used for measuring price elasticity, where the change in price is infinitesimal. Okay, point elasticity makes use of derivative rather than finite changes in price and commodity. It may be defined as follows. Point elasticity is equal to minus dp by dq into p by q, where dp by dq is the derivative of quantity with respect to price at a point on the demand curve, and p and q are the price and the quantity at that point. Point elasticity is therefore the product of price quantity ratio at a particular point on the demand curve and the reciprocal of the slope of the demand line. It is to be noted that elasticity is different at different points on the same demand curve. Given a straight line demand curve T, point elasticity at any point, say R, can be found by using the formula RT capital is equal to lower segment divided by RT divided by upper segment. Okay? Yeah. Please take about 2 minutes. Go through this. Please take about 2 minutes. Go through this. Take about a minute more. Any questions, please ask me. Take a minute more. Yes? Let me know once you're done. Okay, now here is the diagram for the previous slide. Elasticity at a point on the demand curve is R. Okay, the price and quantity. Now it shows you the elasticity of this point R as it moves up and down. All right, and we saw the formula percentage change in demand divided by percentage change in price. Now, okay, so I think with this, we will end today's session with this topic and we will continue tomorrow. So thank you so much for being a wonderful audience, and I will continue tomorrow at 8:15 p.m. Thank you. Thank you all for being there.